Picture this, you're a silver trader and you're watching your screen in absolute disbelief. Silver is trading at $72 an ounce in New York, but in Shanghai, it just hit $78. That's a $6 premium for the exact same metal, and it's getting worse by the day. Something is breaking in the global silver market, and what's happening right now could reshape precious metals trading forever. On December 24th, 2025, the Shanghai Gold Exchange closed at $78.49 per ounce. Meanwhile, COMEX futures in New York were sitting at $72.36. That's more than an $8 gap for physical silver in China versus paper contracts in the West, and this isn't supposed to happen. In normal markets, when Shanghai silver costs more than New York silver, arbitrage traders should jump in immediately. They'd buy cheap silver in New York, ship it to Shanghai, and pocket the difference. This process usually takes about 2 weeks, and it keeps prices balanced globally. But here's the problem, that arbitrage mechanism is completely broken right now and nobody can fix it. Let's talk about what's really going on. China isn't just the world's largest silver consumer. They're a superpower when it comes to this metal. They control somewhere between 60 to 70% of global silver supply through production, refining, and exports. And on January 1st, 2026, China is implementing export restrictions on silver. Think about that for a second. The country that supplies most of the world's silver is about to turn off the tap. The numbers are staggering. In October 2025, China exported a record 660 tons of silver to London, trying desperately to ease the global shortage. But even that massive shipment couldn't stop the bleeding because silver inventories on the Shanghai Futures Exchange have crashed to 531,000 kilograms. That's the lowest level since 2015, and demand just keeps accelerating. Here's what makes this situation so crazy. Industrial demand for silver is exploding. Solar panels, electric vehicles, electronics, and now solid-state batteries for EVs. All of these technologies need silver, and there's no good substitute. China manufactures over half the world's solar panels, and every single one requires silver paste for the photovoltaic cells. The country isn't shipping silver overseas because they need every ounce for their own factories. Let me break down what's causing this $8 premium. First, there's a physical shortage. The silver market has been running consecutive annual deficits for 7 years straight. That means every year we're consuming more silver than we're mining and recycling combined. Global silver inventories are being drained month after month and production can't keep up. Second, China's domestic demand is absolutely insane right now. Their industrial sector is booming. Electronics manufacturing, green energy infrastructure, and semiconductor production are all running at full capacity. When you combine that with investment demand from Chinese citizens buying physical silver as a hedge against currency devaluation, you get a perfect storm of buying pressure. Third, and this is critical, logistics and export restrictions. Even if traders wanted to arbitrage the price difference, physically moving silver from New York to Shanghai takes time, costs money, and now faces regulatory hurdles, transportation, insurance, customs, storage. All of these add up. But the real killer is China's upcoming export restrictions. Banks and trading firms know that after January 1st, getting silver out of China will be nearly impossible. So they're not even trying to do the traditional arbitrage trade anymore. The backwardation situation in China is unprecedented. Normally, futures contracts for delivery months further out cost more than near-term contracts because of storage and financing costs. But in Shanghai right now, it's completely inverted. Near-term silver contracts are trading at massive premiums over longer-dated contracts. This is called backwardation, and it screams one thing. People desperately need physical metal right now, not promises of future delivery. Silver lease rates in China have gone absolutely parabolic, hitting levels above 33%. Under normal conditions, these rates hover near zero. When lease rates explode like this, it means there's virtually no available silver to borrow. Short sellers who bet against silver are getting absolutely crushed because they can't find physical metal to cover their positions. The only way out is to buy back ounces in a market that doesn't have any to sell. This creates a vicious cycle of buying pressure that pushes prices even higher. Western markets are feeling the pain too. The London Bullion Market Association reported massive inventory drawdowns throughout late 2025. Physical silver available for immediate delivery in London's vaults dropped to critically low levels. Reports suggest the free float of immediately available silver fell to around 155 million ounces or less. For context, that's barely a month's worth of global industrial demand. India's playing a huge role in this crisis. In October alone, India imported 1,715 tons of silver. That's an enormous amount for a single month. Indian dealers report near zero physical availability, and some silver ETFs in India have actually stopped accepting new investments because they literally can't source enough metal to back the shares. When ETF managers can't find silver to buy, you know the shortage is real. Here's where it gets really interesting for the future. The COMEX in New York and the Shanghai Gold Exchange are supposed to be connected by arbitrage, right? But that connection is severing. The $8 premium in Shanghai tells us that physical reality is diverging from paper prices. COMEX futures are predominantly paper contracts that can be settled in cash. Very few traders actually take physical delivery, but in Shanghai, contracts on the Shanghai Gold Exchange are backed by physical metal that's available for immediate delivery. This is creating a two-tier market, paper silver versus physical silver. And increasingly, physical silver is commanding a huge premium because it's the real thing. You can't make a solar panel with a futures contract. You can't manufacture an electric vehicle with a paper promise. You need actual metal. Looking ahead, analysts are warning that if China reduces exports by 50% starting in January, the global annual deficit could exceed 5,000 metric tons. That would be catastrophic for industries dependent on steady silver supplies. Electronics manufacturers, solar companies, and EV producers would all face severe input cost pressures and potential production bottlenecks. Some market observers are predicting silver could hit $100 per ounce within months if supply constraints persist. More aggressive forecasts based on historical gold to silver ratios suggest potential moves to $200 or even $300 per ounce if the physical shortage intensifies. Now, are these predictions guaranteed? Absolutely not. Markets are unpredictable and a lot depends on Chinese policy decisions, mine production ramping up, and recycling flows. But here's what we know for sure. The fundamentals of supply and demand are completely out of whack right now. We're consuming way more silver than we're producing. The world's largest supplier is restricting exports, and industrial demand continues to grow year after year. The $8 premium in Shanghai isn't an anomaly, it's a warning signal. For investors and industry watchers, this situation presents both opportunities and risks. Physical silver holders are seeing the value of their metal increase not just from rising spot prices, but from expanding premiums for actual deliverable metal. Mining companies with strong silver production are benefiting enormously from higher prices and improving margins. But manufacturers dependent on steady silver supplies are facing a nightmare scenario of rising input costs and potential shortages. The bottom line is this: the global silver market is undergoing a fundamental transformation. The era of London and New York controlling silver prices might be coming to an end. Regional markets like Shanghai, with their massive physical demand and growing financial sophistication, are gaining pricing power. The arbitrage mechanisms that used to keep global prices aligned are breaking down under the weight of physical shortages and export restrictions. That $78 silver price in Shanghai isn't just a number on a screen. It's a glimpse into a future where physical scarcity trumps paper promises, where regional markets operate independently, and where the metal itself becomes more valuable than the contracts written about it. The $8 gap between Shanghai and New York is more than a pricing anomaly. It's a sign that the old rules of global silver trading no longer apply.